What is up, everybody? Good morning. Welcome to the Monday market update. Absent here is my good friend, Nash Paradise. The markets were so wild last week, he decided to take himself on a vacation and just leave me to talk about it. So y'all get me today. Nonetheless, happy Monday. Let's dive into what craziness happened last week. You want to talk about volatility? I mean, I felt like turning that arrow like upside down and saying like off the charts. It was a wild week in mortgage-backed securities. On the 5-year coupon, or on the 5% coupon, we moved over 100 basis points from peak to valley Monday to Friday. Fortunately, today we're bouncing back a little bit. But yeah, last week's volatility started the week at 6.14. We did not just transpose those numbers, ended the week at 6.41. It's also worthy of noting, like a 6.41 rate as measured by Mortgage News Daily, that's like a top tier client, 25, 30% down, 780 plus FICO. What most clients for most scenarios are seeing on a conventional loan would be higher than that because most clients don't have the perfect scenario. So definitely was a high volatility week. We'll kind of dive into the news items next. So let's take a look at what actually happened last week. Last week's economic news, there should have been a lot of good news that came out of this. On Wednesday, we got the CPI, which is this consumer price index measurement of inflation, and it came in exactly in line with expectations. Now, this was for the month of February, and keep in mind, the month of March, we will probably see some big variations in inflation due to what's going on in Iran with oil prices going up. But for February's report, came in exactly with expectations, 0.3% increase. Year over year at 2.4 on the headline number, 2.5 on the core, stripping out food and energy. So really kind of a big nothing burger on Wednesday with CPI. When you look at Friday's data, we got another measure of inflation, the personal consumption expenditures. This is the Fed's favorite measure of inflation. And once again, it came in exactly with expectations, increase of 0.4% month over month, 3.1% year over year, which is up from 3% the previous report, but that's what the expectations were. However, we should have had huge positive market reaction on Friday from the GDP numbers. GDP was expected to come in. This is the second look at GDP from Q4 of last year, which was expectations of 1.4%, and it came in at half of that. It came in at 0.7%. Now, a lot of that is due to the government shutdown and the lack of government spending. However, that should have been something that furthered the markets along, but ultimately, we saw a massive sell-off on Friday once again. And the other thing that could have rocked us a little bit in the wrong direction, but it wasn't too big of an upset on Friday, was the JOLTS report. That's the job opening and labor turnover report. There was an expectation of 6.7 million job creations. It beat expectations, not substantially. It came in at 6.94. So a little bit over expectations for job openings, but ultimately we should have had a good week. But oil just was the thing that kept making headlines, and that's just what we're going to deal with. So let's move on to the next slide. And let's take a look at what we got coming up this week. This week, It's Fed week. Thanks, Nash, for leaving me on Fed week. But hey, we'll talk about what the Fed did at the next meeting. We know what the Fed's going to do. They're going to hold steady. They're not going to move interest rates, especially right now. So really, this week, Tuesday, Wednesday is the Fed meeting. Wednesday, we have the interest rate decision at 2 p.m. Eastern. Where we will likely see markets get a little squirrely on us is when Jerome Powell takes the stage at 2:30 p.m. Eastern Wednesday afternoon. This guy has the ability, we know this, to move markets with his words. We also know he's not a fan of the current administration. I will say the last Fed meeting, Jerome Powell held his tongue and actually did a really good press conference without upsetting markets. Is that going to remain true with what's going on overseas? And, that's going to be probably about every question that the reporters ask him is, future inflation reports with oil, what's going to happen? So we could have some real fireworks on Wednesday afternoon at that Fed meeting. We also have the producer price index, the measurement of inflation that producers, if you're making the goods that you're going to sell, that measurement of inflation comes out on Wednesday. But again, that's for February's data, pre all of this craziness that's going on. So really, all eyes this week are really just going to be on the Fed meeting. Everything else is kind of just meh. Obviously, the producer price index, if it would show a massive increase, expectations are it to come in at 3.7%. If it would come in at 4.5%, we got problems. It could beat expectations. But to me, the real moneymaker for market moving this week is going to be not necessarily the Fed decision, because it's very well choreographed that there's not going to be a rate cut or rate increase, but rather Jerome Powell's press conference afterwards and the tone he takes answering the very direct questions that are going to come up about the future inflation rising due to oil prices. Let's go on to the next slide. This slide is massively changed. Obviously, we are now pushing out the next Fed rate cut all the way, markets projecting into September of 2026. And now not even a second rate cut all the way until September of 2027. This is a huge shift off of what we saw just last week, the week before. It's progressively getting further out. Why is that? That's the question. Like, why are the markets predicting almost no rate cuts coming forward? Well, you got to understand, cost of oil going up impacts everything. It doesn't just impact food and energy costs. It impacts shipping, and the world ships. Everything can be impacted by oil costs. And I've said this before on my own Facebook doing content. If this war with Iran ends quickly, what we'll see is a spike up in inflation, and March's inflation report will likely be a blip in the radar that is expected to be a jump up and come back down. But if this war becomes prolonged, even 2 months, 3 months, 4 months, what the markets are going to begin to expect is March's inflation report is the beginning of a cycle of higher inflation reports. Yes, it's always going to bleed into the year over year numbers. But if this doesn't wrap up quickly, we got 14 days left in March. If this doesn't wrap up very, very quickly, we could see this as the beginning of a cycle of bad inflation reports. Higher inflation means the Fed is not going to be cutting interest rates anytime soon. And I don't think necessarily getting a new Fed chairman is going to change that, unfortunately. Keep in mind, Kevin Warsh is only going to be one voting member of 9 voting members. Just because we get a new Fed chairman doesn't mean the world magically changes or the Fed magically changes. So we definitely are pushing out future rate cuts. At this point, just one more for the year, and really 1 or 2 for next year. But I would think once the March inflation report comes out, this will probably even shift further out. Let's go on to the next slide. As you can see, mortgage rates are not fun right now. So basically, we are back to about September 3rd, where we were on mortgage rates. The good news is that we have opened up this morning above the 200-day moving average. However, the 10-year Treasury is still in a very wide range. Right before we started this, I checked it. It was at a 4.22. Right now, there is really no support on the 10-year Treasury between 4.2 and 4.3, which means any market news, any war news, any news at all is going to have wide vacillations in the 10-year Treasury. If we can convincingly get back underneath of that 4.2, I mean, trust me, I know. We were in the threes. We were there. But if we can get back under 4.2, that has proved to be a very, very, very strong ceiling. But if something's a very strong ceiling, it can also prove to be a very, very strong floor. So we do have to be careful on this. Yes, mortgage rates this morning are opening up 30-some basis points better. We bounced off the 200-day moving average. But at the end of the day, we still have to really watch this thing extremely close because there's no gimme right now. With the way the 10-year Treasury is going, we do have to be careful that we don't get a bit of a whipsaw effect from really any one thing that could pop up on this. Is that the last slide on this? Because I don't, for some reason, my slide on my side crashed. Oh, there's Nash. See, hey, Nash joined us. Look at this. So yes, guys, here's the deal. It was a rough week last week. It was not the ideal thing. It's not what we love to see. But the mortgage game is a game of mindset. And this is what we talked about this morning on a morning huddle I was doing. We have to keep our mindset right and not let the markets dictate our mood and dictate what's going on. Every single loan originator has the same rates. Everybody gets the rates at the same time. We're all in this together. Last week was a rough week. We hope that this week that bouncing above the 200-day moving average can hold, and that recreates a floor and we can start to see some gain come back. But really, it's all going to be on the news of oil this week, and it's going to be on the news of what Fed Powell says at the press conference on Wednesday. So join us back next Monday. We will break down Fed Powell's press conference, talk about what happened, what didn't happen, and hopefully we will be able to put you guys a chart that says 6.41 to 6.2 to 6%. I would love to see it come back to 6%, guys. So, hey, thanks for joining in today. Give Nash a hard time if you see him. He left me high and dry today. So appreciate you guys and have a wonderful rest of your Monday.